Alrighty, good afternoon, ladies and gentlemen. As everyone's making their way into the room, we'll be getting started in just a few minutes here. Alrighty, panelists, you guys can go ahead and unmute yourself now. Everyone hear me okay? Excellent. Well, ladies and gentlemen, we're gonna go ahead and get started in just 1 minute. Our next presentation is a panel discussion on volatility in a changing investment landscape, which is sponsored by Nasdaq. And at this time, I'm delighted to introduce your moderator today. John Black serves as Nasdaq's head of index options product development, leading the teams responsible for enhancing and managing Nasdaq's index options product suite, including Nasdaq 100, index options, NDX, NQX, and XND. Prior to joining Nasdaq, he spent much of his career serving the many facets of the inter-dealer broker industry. John, panelists, it's a pleasure to have you here. I'll let you take it from here.
All right. Thank you very much, Jordan, and the rest of the Money Show team for having us here to speak to the audience. We're really excited to engage in a lively conversation about volatility, especially from the lens of our index options products. Thanks again. As Jordan mentioned, my team's responsible for managing NDX, NQX, and the recently launched XND, which are all Nasdaq 100 index options. They're broad-based index options, and the broad-based index options have really served a purpose in the marketplace for risk mitigation and broad-based portfolio management. So we're excited to be here to talk about our products and the inclusion of volatility into our product suite. Over the past 2 years, we've really noticed two trends in the marketplace. And the first one of those is the adoption of options and index options by the retail customer base. The second observation that we see is the appetite for the Nasdaq 100 and its constituents. As the sectors pulled us through the pandemic, so we have a great representation here on this panel. We want to represent the current state of volatility and the landscape from the lens of the Nasdaq 100. But these are all, it's very much an educational panel on how investors can incorporate volatility into their portfolios and manage their portfolios accordingly. So before we get started, I'm going to go on mute and let the panelists here introduce themselves. We'll start with Mark, move over to Scott, and then Dan can bring it home with introductions. So Mark Merrick's from our index team.
Thanks very much, John. Pleasure to be here with everyone today. Thanks for joining and listening. I've been with Nasdaq for a little over 2 years now, work in the Global Indexes R&D group, kind of splitting my time between index research, new index product development, and all the kind of content related things we do to support indexes that, especially the ones that have products tracking them. Prior to that, I spent 3 years running a long-short quant equity strategy under Roundtree Capital. Prior to that, started my career at Citi, working primarily in client strategy in the investment banking division.
Thank you, Mark. And Mr. Nations.
My name is Scott Nations. I'm one of the founders of Nations Indexes. Nations Indexes is the creator of the volatility methodology that is used in the VolQ product. And all of our volatility analysis, all of our development came out of decades of experience that we have as proprietary option traders, first in the pits in Chicago, the index option pits in Chicago. And then later when we moved upstairs, we realized that we could use some of these products that we had created ourselves in our own trading. They would really give us special insight into what was going on in the index option world. And so the VolQ methodology, which uses our Voldex methodology, and then all of our implied volatility and option cost indexes really grew out of that expertise. The important thing that we'll talk about when it comes to VolQ is that it's different than other volatility indexes because we really wanted to focus on certain parts of the volatility skew. And we'll get into that in a little bit, but it's really great to be here. I appreciate the opportunity to speak with John and Dan and Mark.
Thanks, Scott. And Dan Kerrigan.
Good afternoon, traders. John said, my name is Dan Kerrigan. I'm part of the strategy group for North American markets. And I'm going to put up on the screen just a couple of quick slides to get us started. But my background, I've been a part of the Nasdaq family, marking 17 years in the predecessor exchange, which was Philadelphia Stock Exchange, the birthplace of trading in this country in 1790. So I like to always say that innovation is at the heart of everything that we do at Nasdaq, and today's focus on volatility fits that theme. So just to start with a disclaimer and a little bit of a housekeeping, is that today's discussion is centered around the Nasdaq 100 Volatility Index. And nothing herein today should be construed as a recommendation to buy or sell a security of any type. We're big believers in education for performance, and we salute your willingness to take time today to learn about the new volatility index and how it might be helpful to your portfolio. But we always suggest, if you're working with an advisor, please touch base with them. And we're also going to talk about futures that are listed on CME Group. And it's important to also keep in mind, as with any derivative product, that any example we talk about today does not take into account transaction fees or tax consideration or margin requirements. And of course, futures involve risk. They're not suitable for everyone. So we ask that you're an informed investor, and that starts with today in terms of giving a little bit of an education. So great to see everybody. And John, please go ahead.
Great, Dan. Thanks for taking care of the disclosure slide. This is great. We have like all facets of the industry we have here on this call, as far as index options, index derivatives, and indexes themselves. But really, from a NASDAQ lens, we wanted to take the audience here on this call, take one quick step back and dig into broad-based indexes, what serve as the basis for whether it's cash-settled index options, futures that are traded, the basis to the volatility indexes, and then take you down the path of how to utilize volatility, whether it's from an incumbent standpoint, but we're showing you from the lens of our new product. So first off, I want to go to Mark and talk a little bit about the construct of the Nasdaq 100. How names are added, what makes it different, how market cap really comes into play into the creation of our index and why it's different. I don't know if you want to take it to start.
Sure, I'll do a minute or two quickly on that to kind of get people up to speed on the methodology. So the Nasdaq 100, it's the 100 largest non-financial companies that list on the Nasdaq exchange. So you may have a little over 100 unique securities on there if you have dual share classes from companies like Google, but it's 100 companies reconstituted once a year in December, rebalanced on a quarterly basis. And it is modified market cap weighted. So it's not straight, the weightings are not a straight function of market cap. We do have caps in place both at the individual constituent level and at the top 5 level to prevent some over concentration in the index. The other thing I would point out to folks comparing to things like the S&P or the Dow Jones, this index is systematic. There is no committee that is sort of taking a view on, well, is this one of the 30 most important companies in the country? Like the Dow Jones, is this company's fundamentals record, worthy of being added to the S&P 500, like you had with Tesla back in December? Prior to that, Tesla had been part of the Nasdaq 100 for 7.5 years. So those are some of the kind of high-level differences. Again, the biggest feature being it's based on exchange listing, Nasdaq only. That also opens you up to some non-U.S. companies. Not based in the US that may list on the Nasdaq exchange and just make it into that top 100 non-financial categorization.
Thanks, Mark. That's really helpful when we think about a broad-based index and how it's constructed, why we do what we do at Nasdaq and what's different about it. Scott, we've worked together for the last couple of years getting the VolQ methodology in place and using VolDex as a baseline for it. When you think of volatility in the overall marketplace, what attracted you to taking your methodology and using the Nasdaq index options for VolQ, and why is that important for the investor to really think about methodology in volatility when they want to use products?
Right. Well, the first question is why Nasdaq 100, and Mark did a great job of explaining that. Nasdaq 100 is completely objective. You don't have a bunch of people in a room picking stocks, which is what some other indexes are. And the important thing also is that everybody's portfolios are starting to look more and more like the Nasdaq 100 because of all that. So that's why we wanted to be involved with the Nasdaq 100. Then the question becomes, what about the VolDex methodology or the VolQ methodology? Why is it important? Why is it special? Our methodology focuses on precisely at the money options. So precisely those options that have strike prices that are right where the market is trading. And those are the most important options. Those are the ones that are going to tell you the most. Some other volatility products include nearly every option that's listed in the 2 relevant expirations. And, an option, say a put that's 50% out of the money, that's not really going to explain very much about what's going on in the volatility space. So that's why we think that it's important that people focus on volatility on the Nasdaq 100, and why we think it's important that they focus on at the money implied volatility. We like to say that what we do is we deconstruct skew. So what we mean is you can look at option prices with a variety of strike prices and get a better understanding of what's really going on in the market.
Thank you, Scott. I want to go back to Mark on something, and I think it's important to recognize, and again, whatever index option or volatility complex that you're trading in your portfolio, I think it's important to understand the makeup. So we do have different, we were talking about some of the constituents like Tesla and the market cap weighted nature of the Nasdaq 100. But Mark, from a sector profile, I know that Nasdaq's historically been, our index is heavy on technology and biotech and some other ones. Do you want to comment on the construct there from what's represented in the marketplace and kind of how we have what's happened coming out of the pandemic? Maybe you could comment there.
For sure. That's a good point. And I'll start with the sector point, and that is that, it's certainly gotten a reputation over the years as being a tech index, right? Tech companies disproportionately list on Nasdaq versus the NYSE. But if you look historically over the last 2 decades or so, the tech ratio, if you're going by something like the ICB system, which is what we use here within Nasdaq to classify sectors and industries, that ratio has been remarkably consistent between about 50 to 60%. So if you look recently, it's been around 55% tech sector weighted as an index. That's roughly double what the S&P averages. And then if you look at the other top sectors in the consumer space, consumer discretionary, but also a bit of consumer staples, as well as healthcare, you end up getting to more than 80% of the index weight from just those 3 or 3.5, call it, sectors, which also happen to be really the sectors that are driving kind of economic growth. If you look at revenue growth over the past decade or decade and a half, those are the ones that have been growing by far the fastest, kind of leaving the old economy sectors behind. The other thing that I will point out to you is in terms of, the percent of the market that the Nasdaq 100 represents in the US these days has gone up tremendously as a result of the pandemic. And it's different this time versus prior market crises where, post-tech bubble, that percentage, that ratio shrank. That was a crisis that was instigated in many respects by the Nasdaq 100 companies and other smaller companies in tech. After 2008, 2009, that ratio dipped as well. But in 2020 and into 2021, we jumped from, contributing like around 30% to the S&P 500 to over 40%. And in terms of the ratio of the total market cap, Nasdaq 100 versus S&P 500. So not just looking at the overlapping firms, we went from mid to high 30s to close to 50%. The top 5 largest companies in the U.S. are now Nasdaq listed. 7 of the 8 largest in the S&P are Nasdaq listed. So the relevance, the contribution to the overall equity market, and sort of who's leading the market up or down more and more is becoming a function of this index.
Understood. I want to stick with you for 1 second, Mark. You mentioned ICB, the sector qualifier. I think it might be interesting for the audience to hear exactly what that is or how that works with our index or what it actually entails.
Sure. So most people probably are more familiar with GICS, which is the S&P and MSCI system for classifying sectors and industries. ICB is just what FTSE Russell has come up with. FTSE Russell kind of similarly is an index business attached to an exchange, the London Stock Exchange. They're very similar at the end of the day. They kind of go through their revisions at different times. FTSE Russell did a big one over the past year, whereas kind of S&P GICS did their big revisions a couple years ago. But at the end of the day, they're all pretty much focusing on the same, 10 or 11 sectors and industries. They might have some differences kind of down below once you get to the subsector level, but at a high level, pretty similar.
Got it. Thank you. All right. So now, I'm going to stick with you 1 more question, then we'll go over to Scott to hear his view on it. But when we're talking about historic volatility for the Nasdaq 100 and the divergence in some other indexes, how do you look at that from your point of view, from a Nasdaq index point of view?
Yeah, so that's a good question. And I was looking at this, you can look at it on a kind of cumulative basis. One of the windows I was looking at recently was since end of 2007 through end of last month. if you annualize the daily volatility of returns for the Nasdaq 100, it's about 23% annualized. The S&P 500 is about 21%. So you're talking on average, it's about, on the long time horizon, it's about 10% more volatile than the S&P 500. Certain years, it will be more than 10% more volatile than the S&P 500. And that's going to be a factor of what's happening to a large extent in the tech sector. Certain subsets of tech, like semis, for example, or software, have been super volatile in the past because of their cyclical nature. We don't know if that's always going to continue, but that kind of drives some of those elevated periods of volatility. But when you look at what happened last year, actually the Nasdaq 100 had a much lesser drawdown during the bear market in March, was less volatile than the S&P 500 as well as the Dow. And so when you look at it on a, kind of sharp ratio basis, you've got more than double the returns of the S&P 500 over that time period since end of 2007, and 10% higher vol. So from a sharp, risk adjusted perspective, it's a really superior performing product.
Thank you, Mark. Now, Scott, I want to turn that over to you as far as the, we talk about VolQ and this new index that Nasdaq launched. Well, it's not so new as an index now. It's been around since I think January of 19. But when we think of VolQ and its divergence and its correlation to some of the other volatility indexes, I think it's important I've always felt managing the index options that having a separate representation of volatility pointing towards our index was important because they're going to function in different ways. So when the audience thinks of volatility, how is it unique to the NASDAQ 100 versus some other constituents out there?
Well, again, it's by focusing on precisely at the money options, you understand what's really going on with the number, frankly. So for example, today, VolQ, the cash index gained 94 cents. That's up over 5%. But you understand exactly where that performance is coming from. You know exactly what that means. You don't have to wonder if that's coming from a bunch of deep out of the money puts that people are bidding up for whatever reason. You know that it's coming from juicy options, as we would say. So then, John, the question becomes, how can traders use volatility? And the best way, well, at least the first way, was to hedge a portfolio. And again, as portfolios look more and more like the NASDAQ 100, the ability to hedge NASDAQ 100 implied volatility is going to be really important. So again, the first uses for volatility were as a hedge, because volatility increases when the NDX, the NASDAQ 100, falls. And you can see this here. You can see in the turquoise line, the blue line is the NASDAQ 100, and the black line is VolQ over the past 18 months. So you see the big spike in volatility when COVID really presented. The important thing here is that the correlation between VolQ and the NASDAQ 100 index itself, and again, more portfolios are starting to look like the NASDAQ 100, the correlation is really high. It's negative 77%. And John, that correlation is bigger. It's more helpful to use volatility as a hedge than, say, fixed income. The correlation between the NASDAQ 100 and what is usually viewed as a hedging instrument for equities, which is fixed income, that volatility, that relationship, that correlation is lower. So there are a couple of ways to use VolQ here, and we're going to talk about the futures in a bit. One is as a hedge. If you're long a portfolio that looks like the NASDAQ 100, then you can be long VolQ volatility in order to use a hedge. There are also ways to speculate. If you think that maybe volatility is going to be very low over the rest of the summer, then one way to approach that would be to potentially short a VolQ futures contract. So there are ways to hedge and to speculate using VolQ futures.
Thank you, Scott. I appreciate that answer, and I think the audience would as well. You bring up the futures. I think that's a good transition to bring in Dan here and ask him some questions. Dan, you've been instrumental in VolQ from inception and working with Scott. Can you tell us a little bit about the futures, the partnership with CME, kind of, and how futures are used from a volatility standpoint?
Sure. Well, the good news is that VolQ futures, which goes by ticker symbol VLQ on the CME Globex platform, they're available for trading each business day. And our view is that before options could come, we need to have futures. Why? Because futures acts as the true underlying upon which options are based. How is that possible? Futures, when you look at their expiration date, it's giving you a look into the forward 30-day window of volatility. So the future of volatility is represented by VLQ futures. And in terms of our strategy to get launched, we have a great partnership with CME, launched futures last October. And with any new futures contract, you need to have liquidity. CME has instituted a market maker program that provides the ability for traders not only to get into a position, but importantly, to be able to exit a position. So you can expect on average about a 30-cent bid-ask spread, anywhere from 5 to 10 contracts up on the bid-ask. But what's important to take away from today's presentation is how are VLQ futures when compared to the incumbent futures contract? And that's where contract specs come into play. The multiplier is the same, $1,000 multiplier. So is VolQ, the index is at 15, you multiply it by 1,000, it's a notional value of $15,000. And the futures trade in minimum tick increments of 5 cents. That times $1,000 is $50. So we have worked with CME to tailor make the futures contract so it fits the risk horizon of, for example, VIX futures, whether you're a retail trader, bank trader, hedge fund, or what have you. So it gives you an opportunity to look at volatility in terms that you're already familiar with.
Thanks, Dan. I appreciate that. And Scott, as far as you see it, VolQ futures, how does the futures fit into the entire landscape when you think about a trader managing a portfolio and they use the futures? How do they take index options if they're trading an index options book and they're utilizing the futures to either hedge or to express a different form? What are they using for the futures?
Well, let's take one step back. If any hedger or trader is using Nasdaq 100 index options, then a huge portion of that experience is going to be implied volatility and changes in implied volatility. And if the reason that you're using options is to get exposure to volatility, then we can simplify the whole equation by simply suggesting that they use VolQ futures. And so we're going to winnow out some of the directionality. We're going to some of the specifics as to strike prices, what you might have to do actually at the end of the day. And so that would be one way for people to get more direct exposure to implied volatility, is to use VolQ futures. There are other ways that somebody can use these products. And a really interesting one, and I know Dan has a chart of this, is to compare VolQ, the VolQ index, to VIX. And this is the sort of thing that having VolQ allows us to do. And there you go. You see that if you look at the relationship between VolQ and VIX, and that's the black line, and it's the simple ratio of VolQ divided by VIX. And then again, you look at the Nasdaq 100, which is the turquoise or blue line. That ratio of volatilities tends to point to inflection points. And you can see here that going back to 2014, when that ratio is either really high or really low, then you tend to have oversized moves in the Nasdaq 100 in the next 10 days. So this is one way that traders can use the cash indexes to in their trading. So for example, when that ratio is really low, that is when VolQ is really low compared to VIX, then the average return for the Nasdaq 100 over the next 10 days is over 1.5%. And even when that ratio is really high and it's in the top quintile, then you still have a pretty good move. So it's interesting to me that you get the biggest moves when that ratio is at an extreme. and quickly, the lowest quintile would be that ratio below 0.94, and the highest quintile would be that ratio above 1.15. So that's really interesting. But quickly, John, another way that people can use VolQ as a trading vehicle, not just a hedging vehicle, is to look at the basis. And if you look at the basis between VolQ, and basis very simply is the cash index versus the futures. If you look at the basis for VolQ versus the basis for VIX, that can also be a great way to trade. And we keep track internally of that. When the basis for one is more than $1 away from the basis for the other, then that can really highlight a relative value trade. That means that one futures contract is relatively inexpensive. You can buy that one. That means that another volatility futures contract is relatively expensive. You can sell that one. So you end up having a spread on that can be really interesting. And as an example, right now that basis went out today at about 34 cents. So it's about in line, but when it gets out of line, when the basis of one is more than $1 above the basis of the other one, that can be a great time to put on a relative value trade.
Got it. Thank you, Scott. I think all of this is very, very important for everyone to hear. As portfolios evolve, as the index evolves, as new names are added to it, for not just Nasdaq, but for all the broad-based indexes and how portfolios are constructed, it's important to recognize that when we think about volatility, that there's different measures to point to different ways of volatility, whether it's the at-the-money strikes versus the full swath of strikes in the index options, whether it faces off against the Nasdaq 100 or the S&P 500, and we really need to look at volatility from a portfolio landscape. And I think we've done a great job. Thank you for your input there. I do have one more question for Dan. I know you've been working hard on the cash index options. We received approval from the SEC in earlier this year in late April, early May. And can you tell us a little bit about those options, where they're going to be listed, but really how folks can use those index options in their portfolio? I think that'd be very helpful.
Sure. NASDAQ has a long history of introducing new products, but new products only work for investors if you can see them on your trading screen, if you can easily find them. So VolQ Futures will have the same attributes as any other index option that you may pull up on your online broker trading platform. You're simply going to put in the base symbol, which is VolQ. And as you know, that will trigger an options chain, which will allow you then to designate which month, which strike that you wish to input. But the bottom line takeaway from today is that if you today have on your screen a list of favorite tickers that you follow, I'm sure you've got all the main indexes. Put up their VolQ in addition to your VIX to give it a look-see at some of these ideas that Scott had. The clear takeaway, if you can access VIX options quickly and efficiently on any broker-dealer platform, you'll be able to do the same with VolQ options.
That's great, Dan. Thank you. I think we're coming up on we're almost ready for some Q&A from the audience, but I wanted to just kind of go around the horn one last time. I'll start with Mark, go to Dan, and then finish up with Scott. Just about, just a generic, the way you look at volatility, how the audience should be thinking about it. The real goal here was to educate from the start of a broad-based index, and then how you get to volatility, and how when we look at index derivatives and indexes, you really have that base index, then you have futures and options, then those options create a volatility index, and then you have options and futures on that volatility index, and how that whole system works together for portfolio management. But any closing thoughts, Mark, on what we talked about today?
I'll keep it brief because I'm not so much the options and vol expert here, but I mean, certainly the way I think of volatility is as an asset class, right? It is a derivative of what's going on in the overall market, but I think it's certainly earned a reputation over the past couple decades, right? Started with VIX to be its own asset class. I think it totally makes sense that when you're thinking about something like the Nasdaq 100, which has one of the largest ETF products in the entire world, $180 billion invested in the Qs, that it deserves its own sort of suite of volatility products that are attached to it, and that, investor interest and liquidity is going to quickly follow around that because of the things we talked about earlier in terms of, what makes the Nasdaq 100 unique from the rest of the US market, what drives some of the performance and volatility differentials. We didn't even get into things like the fact that, the yield on the Nasdaq 100 is quite a bit less than the S&P 500 because it's more of a growth and tech-oriented space. And that has its own implications in terms of how you try to make up for some of that lost yield by potentially harvesting volatility. So I'll leave it at that, and I'll turn it back over to the experts. Thanks.
Thanks, Mark. Dan, any closing comments on volatility, your outlook for the next year?
We're adding to the volatility horizon by bringing VolQ futures and options to market. Important to note that the expiration for these products are the exact same as VIX options and futures. And one important point, John, for retail investors, do you ever wonder, what does that price on the screen mean? What's the volatility index telling you? It's an annual percentage rate that has to be constructed into months. So here's a quick trick that you can put where you're trading a portfolio. Take the volatility index, VolQ, and divide it by 3.42, which is the square root of 12 months, and it gives you the expected 30-day potential trading range from up to down. Here's an example. If VolQ is at 25, you divide by 3.42, it gives you a range of 7.3% on the upside to the downside. So here's what you know. The higher VolQ goes, it's like a megaphone broadcasting the market direction over the next 30 days. The higher it gets, the louder it gets for you to take attention to help protect your portfolio.
Thanks, Dan, very much. I'm gonna leave it to Scott to wrap things up, and then we'll go back to Jordan for questions.
Okay, John, thank you. I think the important thing is that every trader I've ever known is desperate for opportunity and product to trade. And that's really where volatility in VolQ is particularly powerful. It's a brand new product to trade. It's absolutely unique. And when you're trading it and combining it with, say, a portfolio, you get absolutely unique risk return profiles, which are superior. If you're an investor, you get superior risk return profiles. And I'm glad Dad mentioned the expiration, because I mentioned, for example, putting on a spread between VolQ and VIX. It's important to know that those two contracts, they settle the same morning of the same day of the month. And so since these are cash settled products, you can take them to expiration knowing that you're going to get the value you deserve at that settlement.
Scott, thanks very much. From an index options lens at Nasdaq, I'm always, every conversation on volatility, I really appreciate. I learn a little bit, take a little bit back. So hopefully, what we presented here today, folks can take something back and reach out with any questions. I think you can point them through Jordan and the Money Show. But I'll kick it back to Jordan if there's any questions that he wants to bring out here today. We're certainly available to answer those.
Well, first off, I want to thank each of the panelists for making time to join us this afternoon. And I want to thank Nasdaq for being an excellent partner of the Money Show. We have several questions that have come through. So let's try to spend no more than 2 minutes per question so we can try to wrap them up before our time is up. Let's jump to our first question. One of our audience viewers writes in, is there any ETFs, MFs, or ETNs linked to VolQ yet?
I'm gonna pass that off to Dan, because I know he's been working hard on the product itself and working with the CME on the futures.
Not yet, but stay tuned to a screen near you, part of our forward new product development plans. We want to provide the same ecosystem that with the current incumbent volatility product. So time will tell, but the answer is a lot of enthusiasm around this product.
Yeah, I'll just add there, Jordan, that it really is a process to get the index up and running, to launch the futures, to have the cash settled index options, to have the whole ecosystem going, and that's when you'll start to see the other products develop. So stay tuned, stay in touch with Nasdaq.
Excellent. Our next question is, are there any bearish leverage tools to trade VolQ like inverse SVXY?
I would just for sake of time, revert to the previous comment that there's nothing yet, but
Okay.
stay.
Excellent. Our next viewer writes in, what's the difference between VolQ and VXN?
I can.
I'll,
Go ahead, Scott.
I'll take that one. It's a fundamental difference in that VolQ focuses again on precisely at the money options, 30 days to expiration, but precisely at the money options. So you know exactly again what the index is telling you. VIXN uses the VIX methodology, which uses essentially every out of the money option listed in the two relevant expirations. That can often be hundreds and hundreds of options that go into the index. And it's a variable number of options. So some very, very, very deeply out of the money options often have influence on VIXN, VXN, way more than they should. And so we wanted to do away with that. When VIXN is up 5% like VolQ was today, you have no idea where the input for that move is. Is it coming from out of the money options that are deeply out of the money? Is it coming from more or less at the money options? Is it coming from juicy options? So that's the big difference. The difference is we focus on the options that matter most and tell you the most about what's going on.
Thanks, Scott.
Excellent. And our final question for tonight, and John, correct me if this has already been addressed, but one of our viewers writes in, any thoughts on VolQ futures to hedge our portfolio?
So I think, again, I'll defer to Scott and Dan. I do manage the index options here at Nasdaq, so they'd be more better suited to answer that question.
Scott, I'm going to front run you and just let the audience know that VolQ futures not only are available for screen-based trading, but CME also has a block trading facility. So depending on what you look to do, there's opportunities for screen and negotiated trading. So sophistication is there on the table for volatility traders looking to embrace this new futures contract. It goes by the trading symbol of VLQ plus the month plus the year on the CME Globex platform. And just to call out, there's 4 contract months available for trading right now: July, August, September, and October. Scott?
And as far as the efficacy, again, using VLQ futures to hedge a portfolio that looks substantially like the Nasdaq 100 makes a tremendous amount of sense. You can buy the futures, and that will provide a hedge. We also know that volatility tends to be mean reverting. So if VLQ futures are relatively cheaply priced in an historical sense, then that can be a great time to buy as a hedge. So again, with correlation that's greater than negative 77%, VolQ futures can be a great way to hedge a Nasdaq 100 portfolio.
Excellent. Unfortunately, that is all the time we have for today. Panelists, I want to really thank you guys again for your time. I want to thank you, Nasdaq, for being a wonderful partner. And I want to remind the audience that Nasdaq has a second session coming up within the event tomorrow, Wednesday, July 14th, from 3:30 p.m. to 4 p.m. The topic is on the evolution of index options, democratizing investor access with bite-sized Nasdaq 100 contracts. Seamus Scaring and Tony Zhang will be speaking on that topic, and it'll be an excellent presentation. Gentlemen, thank you so much for your time. John, any closing remarks before we wrap up?
Thank you. We really enjoyed putting this together, Jordan, and we look forward to the feedback from the audience. Thank you.